Gold. You've seen the headlines, you've heard the buzz, it's hitting record highs, and it feels like everyone's talking about it. But what does investing in gold actually look like for an Aussie investor today? Well, we're going to crack that code. We'll break down exactly why it's so popular and, more importantly, how you can get involved.
Okay, let's just dive right in with a number that's pretty much impossible to ignore: 71%. Yep, that's the approximate gain gold has seen in just 12 months. It is an absolutely staggering figure, and it highlights one of the most dramatic bull runs this precious metal has ever had.
But here's the thing, this isn't just some recent fad. Gold's appeal is timeless, right? It's always been seen as this safe store of value, a portfolio hedge. Whenever the economic waters get a bit choppy, we're talking inflation, global tensions, investors have historically rushed to gold as a safe harbor. So that brings us to the big question, doesn't it? It's one thing to understand why you might want some gold in your portfolio, but it's a completely different thing to know how to buy it. The good news is, it's not about buying a physical bar and hiding it under your mattress anymore. So, here's our roadmap for today. We'll kick off with the modern gold rush, then we'll explore the three main paths to investing. We're going to compare physical gold against ETFs, touch on trading without the actual bullion, and then finally help you choose your own golden path. Right, let's get into it. Section 1, the modern gold rush. Look, while gold's recent performance is definitely turning heads, its fundamental appeal is as old as time. It's always been that hedge against uncertainty, and now we're going to break down the core reasons why.
So, the key thing is that investors are drawn to gold for a few really good reasons. It offers potential for long-term returns. It's been rising over 11% a year since 2003. It's a fantastic tool for diversifying your portfolio, a hedge against inflation to protect your spending power, and a risk hedge when things get uncertain. And for us here in Australia, it also offers currency diversification against our Aussie dollar.
All right, on to Section 2, three paths to investing. Now that we've got a handle on why people invest, let's get practical and explore the three main ways you can actually get exposure to the price of gold. It really just boils down to these three choices. First, you've got physical bullion, owning the actual metal stored away in a vault. Second, you can invest in gold ETFs on the stock exchange, basically buying shares that track the gold price. And third, you can trade gold CFDs in a digital marketplace, which is all about speculating on price movements. Let's start with path number 1, physical bullion. This is the most traditional way, right? You are literally buying and owning the actual metal, whether that's bars or coins. A place like the Perth Mint, which is backed by the government of Western Australia, is one of the most recognized and trusted names in the game for this. Now for path 2, gold ETFs. Okay, think of an ETF like a share you can buy on the ASX, but instead of representing a piece of a company, it represents a tiny piece of a massive stash of gold that's sitting in a super secure vault somewhere. It's designed to mirror the price of gold, which makes it a really, really simple way to invest. And this chart just illustrates how it works perfectly. You can see the price of the Perth Mint Gold ETF, that's ticker PM Gold, on the right, and it's plotted against the actual spot price of gold in Aussie dollars on the left. See how they move in almost perfect lockstep? You're getting direct exposure to the gold price, but with all the convenience of just trading a normal share.
So, how do you actually buy one? Well, it's surprisingly simple. Using a broker like CommSec, you just open an account, search for the ETF's ticker code, decide how much you want to invest, choose your order type, either at the current market price or a specific limit you set, and then you just review and submit. It's the exact same process as buying any other share on the ASX.
Okay, let's dive a bit deeper with Section 3. We're going to put the two most popular long-term options, physical bullion and gold ETFs, head-to-head. This should really help you figure out which one might be right for you. So what's really interesting here is the trade-off. With physical gold, you get that tangible ownership. You can literally hold it, and the peace of mind of a government guarantee. But you have to deal with storage and insurance, and you'll pay higher upfront costs, which are called fabrication premiums. On the other hand, with gold ETFs, your ownership is indirect through shares, but it's incredibly liquid, super easy to buy and sell, with zero storage hassles and just lower costs overall. Okay, let's move on to our fourth section. Trading without the bullion. Here, we're going to look at our third path. And this is an option really designed for more active traders, people who are focused on short-term price movements rather than long-term ownership. This is where gold CFDs, or contracts for difference, come into play.
Now, the crucial thing to understand here is that you never, ever own the underlying asset. Instead, you're basically making a bet on whether the price of gold will go up or go down. This completely removes all the hassles of physical ownership, making it a really flexible tool for short-term trading or for hedging other parts of your portfolio. And finally, our last section, choosing your golden path. We've covered a ton of ground, so let's pull it all together to help you match the right investment type to your own personal strategy and goals. This table just lays it all out beautifully. Look, if your goal is long-term wealth preservation and you want that absolute rock-solid security of direct ownership, physical bullion is your path. Just be ready for those premium and storage costs. If you're a long-term investor looking for easy diversification, gold ETFs are pretty much ideal. Their costs are just brokerage and a very low annual management fee. For instance, PM Gold's is just 0.15% a year. And if you're an active trader focused on short-term moves, gold CFDs offer that flexibility, with costs like spreads and overnight fees. So, what's the ultimate takeaway from all this? It's simple. There is no single best way to buy gold. The right choice for you depends completely on what you want to achieve, how much risk you're comfortable taking on, and how long you plan to invest. It's all about matching the tool to your personal game plan. And that leaves us with one last big thought to ponder. As we navigate this world that's dominated by digital assets, by crypto, by instant online markets, does holding a physical, tangible piece of gold still represent the ultimate form of financial safety? Well, that's the question right at the heart of this modern gold rush.